Have you ever wondered why so many product based businesses crash before they even take off? According to a recent survey by the Harvard Business Review, over 60% of product based startups fail within the first 3 years, not because their ideas were bad, but because they didn't understand their cost structure, pricing, or break even points. Let that sink in. They jump into production, bought raw materials, hired workers, started selling, but never asked, how many units must I sell to cover my cost? What happens if sales drop or cost rise? Am I even making a profit or just staying busy? That's where cost volume profit analysis comes in. It's not just a finance concept, it's your business survival tool. And if you're running or planning to start a product based business, that is something you cannot afford to ignore. In this video, I will walk you through how cost volume profit analysis works and how you can use it to make a smarter profit focused decision. So don't skip this. Your business might depend on it. Welcome to the Record Keeping Lab, where we turn numbers into business powers. Like, subscribe, comment, and share this video to someone who needs to hear this. Let's get into it.
Cost volume profit analysis or break even analysis is a decision support information that helps producers to know the number of units of a given product that they need to produce and sell so they can be able to recover their costs of investment for the period and to start earning profit as well. With this analysis, producers can avoid loss, target a given amount of profit, and control costs. The cost volume profit analysis formula. This analysis begins with the equation P equal to SU less VCU less FC, where P equal to profits, SU equal to sales per unit or selling price per unit multiplied by quantity sold. VCU equal to variable cost per unit or variable cost price multiplied by quantity sold. And FC equal to fixed cost for the period. Now going back to the formula again, we are saying that profit is equal to selling price per unit multiplied by quantity sold less variable cost price per unit multiplied by quantity sold as well less fixed cost. This happens to be the major formula to begin the analysis of the break even. So to avoid loss, the producer will need to know the number of units to be sold that will provide an amount of money or revenue that is equal to the total costs incurred for doing business. Now, selling this number of units will neither bring profit nor loss, but it will at least help the businessman to be able to know the number of units to be sold so as to avoid loss. It helps the businessman to trade with caution while doing business. It is known as the break-even units or break-even points. We also have the break-even in Naira. Now let's talk about the break-even in units. To find the break-even in units, we start with the formula P equal to SU less VCU less FC. Now, since we are looking for the break-even in units or in quantity, we'll make U the subject of the equation. And in doing this, we'll bring terms that are similar to one side. Therefore, we now have P plus FC equal to SU less VCU. We can factorize the side that we're having U in two places, such that we now have P plus FC equal to bracket open S less VC bracket close U. So making U the subject of the equation, we'll now have in brackets S less VC bracket close U equal to P plus FC. Now we have to divide by the coefficient of U, or what will multiply by U, what is multiplying by U there, and that is S less VC. That is the coefficient. We divide both sides by the coefficient of U. So as you can see, S less VCU equal to P plus FC, and we'll divide. By the time we do this division, we'll now have U to stand by its own, U equal to P plus FC divided by S less VC. That is what we now have as the break-even formula. But note that at the break-even point, P, which is profit, is equal to 0. So at that point, the business is neither gaining nor losing money. Therefore, if P is equal to 0, U, which is quantity or unit, will now be equal to fixed cost divided by sales per unit less variable cost per unit. U equal to break even in units, while F is equals to fixed cost. Now, the difference between S less VC is called the contribution margin per unit, or the unit contributed to sales. So, U equal to FC divided by CM, or contribution margin. So we cannot apply this formula whenever the producer wants to know his break even in units sold. At this point, we'll now apply the cost volume profit analysis to a real business situation. And in this case, we will be applying it to a water processing or production company. Now, the case study we will be looking at here is a case study of a water production company named by Everspring Waters. Let's read the problem relating to Everspring Waters and how cost volume profit analysis can be applied to making decisions in this company. Please, let's read out the questions.
Ever Spring Waters produces and sells sachet water at 200 naira per bag. The variable cost per bag is 120 naira, and the annual fixed cost is 8 million naira. Question: how many bags must Everspring sell in a year to break even? Number two, using the same cost and price structure as above, Everspring Waters wants to earn a 20 million naira annual profit. Question: how many bags must be sold to achieve this profit goal? Number three, using the same detail, that is, selling price is equal to 200 naira, variable cost 120 naira, fixed cost 8 million naira. Question: what is the break even point in naira?
Now, let's address the solution to all three questions by beginning from question 1. Question 1 answer. Now, to address the question number 1, we use the formula, the break-even unit formula, which is U equal to FC divided by CM, which is contribution margin. FC, this is fixed cost, is equal to 8 million naira, and CM is equal to 200 less 120 naira. So contribution margin, or CM, becomes 80 naira. U, therefore, is 8 million naira divided by 80. Thus, the number of units to be sold to break even becomes 100,000 units of water bags. Question number 2 answer. Now, we note that question number 2 address a situation or scenario where the company is now targeting to make a profit of 20 million naira. So at this point, the break-even formula will change in that profit is no longer equal to 0, but profit is now 20 million naira. Thus, the formula becomes U equal to FC plus P, not FC alone. FC plus P, which is profit, fixed cost plus profit divided by contribution margin. Now, U now becomes 8 million naira plus 20 million naira profit divided by 80 naira, that is contribution margin. The units to be produced will now be 28 million divided by 80. So we have 350,000 bags is what we need to be sold to make a profit of 20 million naira. Question number 3 answer. Now, to find a break even in naira, we'll have to do something. That is, we'll have to replace the contribution margin unit with contribution margin ratio, or contribution margin percentage, that is CMRO instead of CM. So in the break-even unit equation, where you have U equals to FC divided by CM, what we'll now have is, instead of U, we'll now have break-even in naira equal to FC divided by CMRO, where CMRO, like I mentioned, refers to contribution margin ratio or contribution margin percentage. So contribution margin ratio, or CMRO, is equal to contribution margin units divided by the selling price per unit. Now, when you do this division, what you have is the percentage of contribution to sales. The percentage of contribution to sales is what you now have. So CMRO in this our situation or scenario rather will have contribution as 80 naira divided by 200 naira, which is sales. So CMRO is equals to 0.4 or 40%. 40%. Therefore, break even in naira will now become 8 million naira divided by 0.4. So break even in naira or revenue is equal to 20 million naira. All right, so at this point, I think I should engage you with a question. So please pay attention to the question on cost volume profit analysis.
Using the CVPA formula, P equal to SU less VCU less FC, find the number of bags to be sold if Ever Spring Waters were to earn a profit of 12 million naira annually. 2. What will be the profit if fixed cost increases by 10%?
Please drop your answers on the comment section. All right, thanks for watching. But do you like to know more about the classification of cost in terms of variable cost and fixed cost? And if your business is a product related kind of business, you want to really know how to classify your costs so that you can make use of cost volume profit analysis, watch out for the next episode.